Section 2.2 to 2.3 Asset Classes, Introduction to Asset Classes, 2.2 Bonds, Fixed Income. There are several types of bonds available in the financial markets. Here are four common types. Government bonds. Government bonds, also known as sovereign bonds, are issued by national governments to finance their operations and projects. These bonds are considered to have a low default risk because they are backed by the issuing government's ability to tax or print currency. Government bonds are typically issued by countries with stable economies and strong credit ratings. Examples include U.S. Treasury bonds, issued by the U.S. government, and German bonds, issued by the German government. Corporate bonds. Corporate bonds are issued by corporations to raise capital for various purposes, such as expansion, acquisitions, or debt refinancing. When you invest in a corporate bond, you are essentially lending money to the issuing company in exchange for regular interest payments and the return of the principal at maturity. Corporate bonds can vary in risk depending on the creditworthiness of the issuing company. Bonds issued by companies with higher credit ratings tend to have lower default risk but may offer lower interest rates. Examples of corporate bonds include those issued by large companies like Apple, Microsoft, or General Electric. Municipal bonds. Municipal bonds, also known as munis, are issued by state and local governments, as well as government agencies or municipalities, to finance public projects such as schools, highways, or water systems. Municipal bonds can be tax-exempt at the federal level, making them attractive to investors seeking tax advantages. The risk level of municipal bonds varies depending on the financial health of the issuing municipality. Bonds issued by financially stable municipalities are generally considered lower risk. Investors interested in municipal bonds often consider factors such as credit quality, yield, and tax implications. International bonds, also called foreign bonds or global bonds, are issued by foreign governments or corporations in a country's domestic market or in international markets. These bonds allow issuers to tap into a larger investor base and access capital from investors outside their home country. International bonds can provide investors with opportunities for diversification and exposure to different countries and currencies. However, they also come with additional risks, such as foreign exchange risk, political risk, and economic conditions specific to the issuing country. It's important to note that bond characteristics, such as interest rates, credit ratings, and maturity dates, can vary within each bond type. Before investing in bonds, it's advisable to carefully assess the creditworthiness of the issuer. Evaluate the associated risks, consider the potential returns, and consult with a financial advisor to align your investment strategy with your risk tolerance and financial goals. Yield, coupon payments, and bond ratings are important concepts to understand when investing in bonds. Here's an overview of each. Yield. Yield refers to the return an investor can expect to receive from a bond investment. It is expressed as a percentage and is influenced by various factors, including the bond's price, coupon rate, and maturity. There are different types of yields that investors consider. Current yield. Current yield is calculated by dividing the annual coupon payment by the bond's current market price. It provides a measure of the bond's income relative to its price. Yield to maturity. YTM. YTM represents the total return an investor would earn if they hold the bond until maturity, assuming all coupon payments are reinvested at the same rate. YTM takes into account the bond's purchase price, coupon rate, and time remaining until maturity. Yield to call. YTC. Yield to call is relevant for bonds that have a callable feature, allowing the issuer to redeem the bond before its stated maturity. YTC calculates the yield assuming the bond is called at the earliest possible date. Yield to worst. YTW. Yield to worst represents the lowest potential yield an investor may receive if certain conditions, such as early call provisions, are exercised by the issuer. Yield serves as an important metric for comparing bonds with different coupon rates, maturities, and prices. However, it's important to consider other factors such as credit quality, risk tolerance, and investment objectives when evaluating bond investments. Coupon payments. Coupon payments refer to the periodic interest payments made by the bond issuer to bondholders. The coupon rate is the annual interest rate stated on the bond, typically expressed as a percentage of the bond's face value. Coupon payments are typically made semi-annually or annually, depending on the bond's terms. The coupon payments remain fixed throughout the bond's life. Unless the bond has a variable or floating rate coupon, for example, if a bond has a face value of $1,000 and a coupon rate of 5%, the bondholder would receive $50 in annual coupon payments, $1,000 x 0.05. Bond ratings. Bond ratings are assessments of the creditworthiness or default risk of a bond issuer. Rating agencies, such as Standard & Poor's, SP, Moody's, and Fitch, assign ratings based on their evaluation of the issuer's financial strength and ability to meet its debt obligations. Bond ratings typically use a letter grade scale that ranges from AAA, highest quality, to D, default. Different rating agencies may have slightly different rating scales, but the general concept remains the same. Higher-rated bonds are considered lower risk and generally offer lower yields, while lower-rated bonds are perceived as higher risk and may offer higher yields to compensate investors for the added risk. Investors often use bond ratings as a reference point to assess the credit risk associated with a bond investment. Higher-rated bonds are typically deemed safer investments, while lower-rated bonds carry a higher risk of default. It's important to note that bond ratings are not guarantees of a bond's performance or the issuer's ability to meet its obligations. Investors should conduct thorough research and consider various factors before making investment decisions. Understanding yield, coupon payments, and bond ratings helps investors assess the potential return and risk associated with bond investments, enabling them to make informed investment decisions based on their investment objectives and risk tolerance. Assessing interest rate risk and credit risk is crucial when evaluating bond investments. Here's an overview of each risk and how they can impact bond performance. Interest rate risk. Interest rate risk refers to the potential impact of changes in interest rates on bond prices and yields. When interest rates rise, bond prices generally fall, and vice versa. Here are key points to consider: bond prices and yields. As interest rates rise, newly issued bonds tend to offer higher coupon rates, making existing bonds with lower coupon rates less attractive to investors. This leads to a decrease in the demand for existing bonds, causing their prices to fall. Conversely, when interest rates decline, existing bonds with higher coupon rates become more desirable, leading to higher prices. Duration. Duration is a measure of a bond's sensitivity to changes in interest rates. Bonds with longer durations are typically more sensitive to interest rate changes, meaning their prices will fluctuate more in response to interest rate movements. Reinvestment risk. When interest rates fall, bondholders may face reinvestment risk. This is because the periodic coupon payments and the return of principal at maturity may be reinvested at lower rates, potentially reducing the overall return of the investment. Call risk. Callable bonds carry the risk that the issuer may choose to redeem the bond before its stated maturity date if prevailing interest rates decline. This can result in the bondholder receiving the principal back earlier than expected and having to reinvest at potentially lower rates. To assess interest rate risk, investors can evaluate a bond's duration, analyze the potential impact of changing interest rates on the bond's price and yield, and consider their own outlook for future interest rate movements. Credit risk. Credit risk refers to the risk that the issuer of a bond may default on interest payments or fail to repay the principal amount at maturity. Factors to consider regarding credit risk include credit ratings. Bond ratings provided by rating agencies offer an indication of an issuer's creditworthiness. Higher-rated bonds are considered lower risk, while lower-rated bonds carry higher default risk. Investors should analyze credit ratings and understand the potential risks associated with bonds of different credit qualities. Financial health of the issuer. Assessing the issuer's financial statements, cash flow, profitability, and debt levels can provide insights into its ability to meet its debt obligations. Analyzing factors such as revenue growth, earnings stability, debt ratios, and industry trends can help evaluate credit risk. Default probability and historical default rates. Historical default rates within an issuer's industry or specific bond category can provide information about the likelihood of default. Default probability models and credit spreads in the market can also offer insights into credit risk. Diversification. Spreading investments across multiple issuers and sectors can help mitigate credit risk by reducing exposure to any single bond or issuer. To assess credit risk, investors can review credit ratings, conduct thorough fundamental analysis of the issuer, monitor industry trends, and consider the potential impact of economic conditions on the issuer's ability to meet its obligations. It's important to note that interest rate risk and credit risk are interconnected, as changes in interest rates can impact the creditworthiness of an issuer and vice versa. Assessing both risks is essential for making informed investment decisions and managing the overall risk profile of a bond portfolio. Investors should conduct thorough research, consider their risk tolerance, and consult with a financial advisor when assessing interest rate risk and credit risk. 2.3 Cash and cash equivalents. Cash investments, also known as cash equivalents or short-term investments, refer to assets that are easily convertible into cash with minimal risk of loss. These investments are considered low risk and provide stability to an investment portfolio. Cash investments serve several purposes, including liquidity. Cash investments provide immediate access to funds. They can be easily converted into cash or used for short-term needs, emergencies, or unexpected expenses. Having cash on hand ensures financial flexibility and the ability to meet financial obligations when needed, preserving capital. Cash investments are relatively stable and typically preserve the principal amount invested. Unlike other investment options, such as stocks or bonds, cash investments generally carry low to no risk of loss of principal. This makes them suitable for individuals who prioritize capital preservation over higher returns. Short-term income. Cash investments often earn interest or yield, although at relatively lower rates compared to other investment options. While the returns may be modest, cash investments can still provide some income, making them a suitable option for individuals seeking short-term income while maintaining liquidity and capital preservation. Risk mitigation. Cash investments can act as a risk mitigation tool within an investment portfolio. During periods of market volatility or economic uncertainty, investors may choose to allocate a portion of their portfolio to cash investments to reduce exposure to market fluctuations and potential losses. Portfolio diversification. Including cash investments in a portfolio can help diversify risk. By allocating a portion of the portfolio to cash, investors can balance the risk associated with other asset classes, such as stocks or bonds. Cash investments provide stability and can act as a buffer during market downturns. Strategic allocation. Cash investments can be strategically used as part of an investment strategy. For example, investors may hold cash to take advantage of potential investment opportunities that arise during market downturns when asset prices are more attractive. Cash reserves can also be deployed to rebalance a portfolio or meet specific investment goals. Common types of cash investments include savings accounts, money market accounts, certificates of deposit, CDs, Treasury bills, T-bills, and short-term government or corporate bonds. The specific choice of cash investment depends on factors such as desired liquidity, safety, and yield. It's important to note that while cash investments provide stability and liquidity, they generally offer lower returns compared to other higher-risk investment options. Investors should consider their financial goals, risk tolerance, and time horizon when determining the appropriate allocation to cash investments within their overall investment strategy. Money market funds. Money market funds are mutual funds that invest in short-term, low-risk fixed-income securities such as Treasury bills, certificates of deposit, commercial paper, and short-term corporate debt. They are designed to provide stability, liquidity, and preservation of capital. Key points about money market funds include: investment objective. Money market funds aim to maintain a stable net asset value, NAV, of $1 per share and generate income in line with short-term interest rates. They offer investors a way to earn some return on their cash while maintaining high liquidity. Portfolio composition. Money market funds typically invest in highly liquid and low-risk securities with short maturities. They focus on high-quality debt instruments issued by government entities, banks, and corporations. The goal is to minimize credit risk and provide stability to investors. Liquidity and accessibility. Money market funds offer daily liquidity, allowing investors to buy or sell shares at the current NAV. They provide quick access to cash, making them suitable for short-term investment needs or as a temporary parking place for cash awaiting deployment in other investments. Certificates of deposit, CDs. Certificates of deposit are time deposits offered by banks and credit unions. They involve depositing a specific amount of money for a fixed period at a fixed interest rate. Key points about CDs include: fixed-term investment. CDs have specific maturity dates, ranging from a few months to several years. During this period, the deposited funds are locked, and investors receive interest payments at regular intervals. Guaranteed return. CDs offer a fixed interest rate for the entire term, providing investors with predictable returns. The rate is determined at the time of purchase and remains constant regardless of market fluctuations. Safety and FDIC insurance. CDs offered by banks are typically insured by the Federal Deposit Insurance Corporation, FDIC, up to certain limits, providing an added layer of safety for the principal amount invested. Early withdrawal penalties. Withdrawing funds from a CD before the maturity date may result in penalties, such as forfeiting a portion of the interest earned or even incurring a loss of principal. Investors should carefully consider their liquidity needs before investing in CDs. Treasury bills, T-bills. Treasury bills are short-term debt securities issued by the U.S. government. They are considered one of the safest investments available. Key points about T-bills include maturity and discount. T-bills have maturities ranging from a few days to 1 year. They are issued at a discount from their face value and do not pay regular interest. Instead, investors earn interest by buying the T-bill at a discount and receiving the full face value at maturity. Backed by the U.S. government, T-bills are backed by the full faith and credit of the U.S. government, making them highly secure. They are considered risk-free in terms of default risk, liquidity, and auctions. T-bills are highly liquid and can be bought or sold in the secondary market before maturity. They are issued through regular auctions conducted by the U.S. Department of the Treasury, Income and Taxation. The difference between the purchase price and the face value at maturity represents the interest earned on T-bills. This interest is subject to federal income tax but exempt from state and local taxes. Money market funds, certificates of deposit, and treasury bills are all cash investments that provide varying degrees of liquidity, safety, and return potential. Each option has its own characteristics and considerations, and investors should assess their individual needs, risk tolerance, and investment goals before choosing the most suitable option for their cash allocation. Liquidity, stability, and short-term investment strategies are interconnected concepts that focus on preserving capital and providing access to funds in the short term. Here's an overview of each of these elements and their relevance to short-term investment strategies. Liquidity. Liquidity refers to the ease with which an asset can be converted into cash without causing significant price impact. In short-term investment strategies, liquidity is essential as it allows investors to access funds quickly for immediate needs or to take advantage of investment opportunities. A liquid investment can be readily bought or sold with minimal transaction costs and without causing significant price fluctuations. High liquidity is particularly important for short-term investments because these investments are typically held for a shorter duration. It ensures that investors can easily access their funds when needed and make timely investment decisions. Cash equivalents, such as money market funds and treasury bills, are often chosen for their high liquidity as they offer daily or near-instant access to funds. Stability. Stability in short-term investment strategies refers to the preservation of capital and the minimization of investment risk. Investors seeking short-term investment options often prioritize stability over higher returns. They aim to protect their principal and avoid significant fluctuations in the value of their investments. Investments with stability characteristics typically have low volatility and are considered low risk. Examples include money market funds, high-quality bonds, and cash equivalents. These investments offer a lower potential for loss of capital compared to higher-risk investments such as stocks or long-term bonds. Stability is particularly important for short-term investment strategies where capital preservation and the availability of funds are primary objectives. Short-term investment strategies. Short-term investment strategies focus on preserving capital and generating modest returns over a relatively short period. These strategies are suitable for investors with a shorter time horizon or those who have specific financial goals or liquidity needs in the near term. Key considerations for short-term investment strategies include safety. Prioritizing investments with low risk and high credit quality to minimize the potential for loss of capital. Investments such as treasury bills, money market funds, and high-quality short-term bonds are commonly chosen for their stability and safety. Liquidity. Selecting investments that provide high liquidity, allowing for quick access to funds. Cash equivalents and highly liquid assets enable investors to meet immediate financial obligations or seize investment opportunities as they arise. Diversification, spreading investments across different asset classes and issuers to reduce concentration risk. Diversification can help mitigate the impact of potential losses in any one investment and enhance overall portfolio stability. Yield/return, balancing the desire for stability with the need for some level of return. While short-term investments generally offer lower returns compared to long-term investments, investors can still seek opportunities to earn income through interest payments or yields on low-risk investments. Short-term investment strategies are often utilized by individuals or organizations with specific financial goals, such as saving for a down payment on a house, preparing for a major expense, or maintaining an emergency fund. These strategies provide a balance between liquidity, stability, and the potential for modest returns over a shorter time horizon. It's important for investors to assess their risk tolerance, financial goals, and liquidity needs when developing short-term investment strategies. Seeking professional advice from financial advisors can help ensure the suitability of investment choices and alignment with individual objectives.